So to today's speaker on how to tell a good deal from a bad deal on the stock market. Our speaker David Novac appears as co-host on Sky Business Lunch Money and Market Day programs. He's an expert panellist on Your Money, Your Call and Bonds versus Equities TV shows. He has presented for Anthony Robbins on Wealth Mastery, and Robert Kiyosaki, best-selling author of Rich Dad, Poor Dad, praised David's knowledge, saying, David Novac is one of the best stock pickers I know. David uses a combination of fundamental and technical analysis. Ladies and gentlemen, David Novac.
Thank you very much, John. And it's a pleasure to be here, presenting in front of such a sophisticated investor audience here today. Hope I can shed some light or enlighten you a little bit with what's going on, what the methods that I use, but also hope you're surviving this market volatility at the moment, which has been quite extreme. Anyway, I'll just go through my presentation. So first of all, under the Financial Services Regulation, I've got to give you a disclaimer. This is for educational purposes only, and I am licensed. I am an authorised representative of a broker. And that broker is I invest securities in Queensland. I love this quote, which was, when I was young, I thought money was the most important thing in life. Now that I'm old, I know it is. Ain't that the truth? Now, just as John was saying, I started investing back in 1983. I was the CFO of a $6 billion merchant bank, Barclays at the time. And knowing very little about the stock market, and I got one of those hot tips at the time where gold was about 800 US, and I bought this stock and it was called Buddha Gold, so I liked the name and I thought it must be good. It was an exploration company and the shares went up, and I thought, how good is this? How easy is it to make money in the stock market? Until this fateful day here, which was, as you know, that was October the 19th, 1987, of the big stock market crash. And that was a bit of a wake-up call. And so for the last 30 years, I'm sure that some of you have been to the same private school that I've been to. It's very expensive. It's called the School of Hard Knocks. Has anybody been to that one? So I've got 30 years of, I've got a PhD over 30 years in that school. So I'm going to share some of that knowledge today. But Kate and I started our business, Wealthwise Education, in 1997. And as John was saying, first of all, this is our curriculum. We have a curriculum of courses. We have a one-day called Financial Wisdom, a two-day called Invest for Success, options if you want to learn about derivatives, advanced derivative strategies, and then I have what I call a Super Traders program, which is only for very advanced traders who want to trade derivatives on global markets and focusing on the Australian market. But as John was saying, I was a keynote speaker for Robbins in 98 and 99 and in 2001 in Singapore, and then I met Robert Kiyosaki. And I wasn't, looking for these people. I guess when you find your passion in life, they find you, and they were the ones that approached me and asked me if I would speak. So I spoke for Robert around the world for 5 years, and in pretty large audiences in Asia and mainly in the US. And then, as John was saying, for the last 4 years I've been on Sky Business as a regular, certainly on Lunch Money and Your Money, Your Call. So some of the things that I see that comes up for common investor issues is low confidence or lack of knowledge, not sure which stocks to buy, not enough time, don't know when to buy, and don't know when to sell. These are the most common sort of what I call pitfalls for investors out there, especially knowing when to sell is one of the most important things. Impatience and taking on too much risk is the other one, or greed, and putting all their eggs in one basket. So, these are all mistakes that I've made in the past, and I'm sure some of you probably can relate to one or two of these. And finally, the emotion is what drives our markets. I've noticed that fundamentals go out the window when emotions take over. So it's all driven by greed and fear and, macro events. I think one of the things that most investors don't take into account is what's going on a macro level, which can change the fundamentals of the micro level of investing. So I very much focus on the global picture. And when I was teaching for Robert Kiyosaki in the States, I did say in 2005 and 06 that I was warning there was going to be a global financial crisis. I could see there was a debt bubble emanating in the US and around the world, and particularly in real estate in the US, and I could see that something wasn't right here. But most economists didn't see it at the time, which really surprised me that 95% of economists could not see it. Even Alan Greenspan, who was the US Federal Reserve Chairman at the time, in his testimonial before the Senate Banking Committee, when they inquired into the GFC, asking Mr. Greenspan the question, why didn't you see the GFC coming? And now, you've got to remember when Alan Greenspan, the longest serving Federal Reserve Chairman of the US Federal Reserve, who every time he opened his mouth, the markets would move, answered this way, saying that he had not realised that the economic model that he'd been using for the last 30 years actually didn't work. Which is pretty scary. And tonight we have a US Federal Reserve meeting with Janet Yellen talking about whether they're going to lift rates or not, and I've got an opinion about that, which I could talk about later. But the macro issues very much drive the micro issues, so I think there's not enough focus on that that I see from a lot of commentators. So then we come down to stock selection. I look at trends, which are very important, of course, fundamentals, the financial health of the company, and most importantly, risk management or money management. So if we're talking about fundamentals, or what I call facts, there's also opinions from the media and various brokers, and then you've got overriding all that, what I call the trend. So starting off, like I said, with the facts, we're looking at the financial health of companies, their earnings, the strength of their balance sheet, cash flow, and then of course, like I said, you've got the opinions from the media, and I am on TV regularly, so I've got my opinions, of course, and then of course you've got the trend, which are the charts, and a lot of investors actually don't know how to read charts or identify trends. And over my 30 years experience, this is one of the most important things by far than anything I've learned. But combining the fundamentals and the technicals gives you a very powerful formula if you put the two together, which is what I focus on and what I teach investors, is how to combine the two. So if we're looking at technical trends, the simple definition is if you've got high peaks, high troughs, that's an uptrend. So obviously a trend like this, you'll make money if you buy the shares. And then there's obviously a downtrend where you've got lower peaks and lower troughs like this. And if you want a tax loss, this is a good one to buy. And then you've got a sideways trend, which is, as it suggests, trading between two ranges. And Woodside did this for quite some time before it broke out of that channel. I think it was channeling between about 36 to 40, I think, for the last 9 months. It's exactly what Woodside's been doing. But I love this quote by Mark Twain, which history doesn't repeat itself, but it rhymes. So the keys to stock market success is you must have clear rules or strategies, knowing when to buy, when to take profits, and as I said before, when to exit, and knowing how much risk you're willing to take by having a stop loss, and what is your potential reward. So you've got to have a plan, obviously, as you know, before you go into any strategy. So just focusing on fundamentals and looking at financial health of companies, the 7 key fundamentals that I look at are, number 1, the strength of the balance sheet, how much debt they have or how much cash, the earnings per share, and particularly the earnings per share growth over the last 2 to 3 years, and what is the likelihood going forward of that growth sustaining itself. PE ratio, price to earnings ratio. I'm just assuming most of you may already know this, but are you paying too much for a stock or not enough, or is it grossly undervalued, I should say? And then of course the return on equity is an important figure. So how much return on equity is the business getting, what's the dividend yield if you're looking for that, the market cap valuation of that business, and most importantly, the liquidity. Is it easy to get in and out of that particular stock, and what sector is it in? Is it a growing sector? So they're the things that I focus on very quickly, and I can answer questions later, but I'm going to go through examples to demonstrate exactly what I'm talking about here. So if we look at the 10 global sectors, you can see that energy, materials, industrials, consumer discretionary, staples, healthcare, financials, information technology, telecommunications, utilities. Which one would you say at the moment was being the growth sector out of all those?
Healthcare.
Definitely healthcare. Yeah, exactly. Especially if you've got Blackmores, that's for sure. Or ResMed or those companies, or CSL has definitely been a wealth winner, that's for sure, if you've got CSL shares. But let me demonstrate what I mean about combining fundamentals and technicals. And I'm using this as an example. Now it's historical data, but I'm going to use current data as well when I give other examples. But this is just going to demonstrate what I'm looking for. Now GUD was in the consumer discretionary space, and in early 2000 or June 2002, there was a lot of home renovations going on. So they were a white goods manufacturer, so obviously with renovations, their sales were going up. And at that point, their market cap valuation was 207 million, based on a share price of $3.30. Their earnings per share was 33 cents, which was 89% growth on the previous year, which is pretty good. I mean, 89% profit increase on earnings. Their return on equity is 24%, which is excellent. So I look for anything above 15% as a benchmark. And the price earnings ratio, if you take obviously the share price divided by the earnings per share, gave you a PE ratio of 10 to 1. So I look at that and I go, 89% jump in earnings. They're in that white goods area where you've got renovations going through the roof. You've got all those shows on TV. So based on that earnings per share growth, is that likely to continue growing in the foreseeable future? And the obvious answer to that was yes. So is the company undervalued? Looking at the price to earnings ratio, obviously it's not going to do 80% every year. I wouldn't expect that. But if it was doing 15 to 30% growth every year, that's pretty cheap on an earnings multiple of 10. Okay? So just from a fundamental point of view. And then you look at the dividend of 17 cents, which is fully franked. So 5% yield. So this one ticked every single box. So then what do? I go and have a look at the chart. And here's a positive trend. So it ticks every box. The trend is positive and the fundamentals are strong. It's got a strong balance sheet as well, no debt. So, as far as I'm concerned, this is a strong buy. Then we look at the next year, the year after that, and the market cap moved to 285 million. So the share price is now $4.80 and the earnings jumped to 44 cents. So that's 36% higher than the previous year. And the return on equity is now 32%. And look at the price to earnings ratio here, 11. I mean, and the dividend jump, look at the dividend jumping from 17 cents to 26. So even on the current share price, for anybody buying that, you'd be still getting 5% fully franked yield on $4.80. So again, I look at these numbers and I go, am I missing something here? So sometimes it takes a market a while to pick up. And then, of course, this is what the share price did. That was my entry. And obviously you look for a stop loss, and usually you want a stop loss below what I call the previous trough, or 10% below, to limit your loss. And you can see that after it broke out, it went sideways and then continued moving up. June 2004, the market value of this business has now more than doubled in 2 years to 550 million. The share price is $9. Look at the earnings, 69 cents, another 54% growth. I mean, these are stunning numbers 42% return on equity. I mean, and 13 times PE. To me, anything below 15 on a growth like this is incredibly cheap, or even 20 these days. So it has still got upside on a low PE, absolutely. Now the dividend the company's paying is 40 cents. So anybody buying the shares at $9 will be getting a 4% fully franked yield. But if you bought it 2 years ago, your fully franked dividend now is 12% in 2 years, which is extraordinary, fully franked. And consequently, this is what happened. The share price continued to move much higher. So that's just a really good example of, an excellent example of the kind of business you want to be looking for with those valuation metrics, and still undervalued. And it kept going. So then I've thought, well, let's have a look at some current businesses today. And CSL, I just put these numbers up yesterday. You can see the 3 years of history of CSL. Great business. I mean, this one has been extraordinary over the last 10 years. But you can see the share price has been moving up steadily, and the earnings per share growth in 2013, 38%, 12%, so a little bit less the following year, and then jumped again 31% to June this year. And look at the return on equity though, very high, and deserving a high PE, price to earnings ratio. Now it's up there, but it deserves to be up there if you've got those kind of growth numbers. The thing to watch out for companies like any company, whether it's CSL or any other business, is that if there's a disappointment with earnings and investors are paying too much for the share price on a high multiple, earnings multiple, PE, they're paying too much. And you'll see what I mean when we look at Blackmore's. But look at the dividend has been steadily growing for CSL. It's got a small yield of 1.9%, which is only, I think, 50% franked, actually. So it's not really, you're not buying it for yield, you're really buying it for growth, aren't you, this business? And it's a great business, especially with the Aussie dollar being down. That also benefits, depending if it's an export-orientated business, and CSL certainly is an international company, so the lower Aussie dollar will benefit their earnings going forward. So based on those numbers, it's not outrageously expensive. If I look at the share price, you can see the performance there, especially since 2011. I mean, it's gone from $25 to $100. So it's been quite an extraordinary movement. But you can see that the circles represent the earnings period that I just showed you. So for my money, I'd be concerned if it broke below $85. I would have a stop loss at that level. But right now, you'd have to hold CSL, and considering it's still moving up as well, look at any opportunities. For anybody who hasn't bought into it, then you'd buy into it, but make sure you'd have a stop loss as it moves up. So great business, example of a great business. Here's another one, Domino's. Didn't know there was so much money in pizza. Yeah. This one I do scratch my head a bit. I mean, great earnings growth, great return on equity. You can see the business has grown over 2 years from 780 million market value to 3.1 billion. So quite extraordinary, $11 to $36. You can see why. Look at the earnings per share growth there. But the PE is the thing that bothers me a bit here. I mean, you're looking at a price to earnings ratio of 49 times. Nice increase in dividend, you can see over the last 2 years there from 2013, and on a small yield of 1.4%. But, great business, but again, 49 times earnings is sort of stretching the imagination a bit as far as I'm concerned. But it doesn't mean it can't go higher, but certainly if you were in this particular stock, you'd be holding it and certainly having your stops in place or taking some profits, at least, at these sort of levels. Has anybody got Domino's here? Okay. Are you one of the big consumers of the product? You don't look like it. Anyway, real estate is another one, .com, with the housing boom in Australia. You can see another great business. Now, these businesses, these internet businesses in particular, have very low capital cost and high return on equity. So these have been star performers. Anyone in the IT and particularly realestate.com, you can see there the share price has performed very well over the last couple of years. The only thing is, notice the earnings per share growth is starting to slow a bit, as it's eventually if the Sydney housing market slows down, or the property market in Sydney. But you can see the earnings is slowing. The return on equity is excellent, but it is trading on a very high earnings multiple at 29. And you just got to watch this one, because if you see a continuing trend of earnings slowing, then you could get a very sharp price reaction because of the price to earnings ratio that it's trading on at 29. But you know, great growth in dividends, and still today, I mean, it's a small yield of 1.8%, fully franked, which is still beats, I guess, leaving your money in a cash deposit. But here's the trend, and you can see the difference with this one is between those two last reporting periods here, that this one and here, showing that slower earnings growth. So at the moment, when I look at this trend here, it just looks a bit tired to me, and it's choppy and sideways. So again, I would not be rushing in to buy realestate.com. I'd want to see more numbers coming out, and particularly with all the talk about, you know, the housing bubble at the moment. Car sales, been another great business. Look at the return on equity up in the 64% for this year. High earnings multiple, but again, what's the concern that I see here is look at the earnings per share growth. It's been slowing quite a bit. It's down to 3% from the previous year, and trading still on 25 times. You know, reasonable yield at 3.3%. But again, you can see the share price, what it's done over the last 2 years, basically just gone sideways. And you can understand that when you look at the earnings growth is starting to slow there. Flight Centre is another one. It's been a great performing stock until this year. You can see the company is valued at around 4 billion, and this year dropped to almost 3.5 billion. Share price is still 34 cents, but the earnings per share, it's been quite steady, but it did drop by 3% for this year. Good return on equity, and consequently, you can see the price to earnings multiple has come right down to 13 times, which tells you the market is concerned about the future growth of this business. Now, particularly with the Aussie dollar being down, you'll get less people travelling overseas, as Australians love to travel, and their boom time was when the Aussie dollar was up, you know, past parity to the US dollar. A lot of Australians were travelling certainly to the US and to Europe. So you can see that the dividend yield has moved up, but you know, there's a concern about the earnings growth there. And consequently, now the share price is trending down. So just with the fact that it's trending down, this one would not be a business that I would, or a stock that I would buy until I see evidence of a turnaround in the trend. Because one thing I've learnt very expensively is you never know how low a stock can go. I always get asked that question, you know, on TV, how low do you think this stock could go? I said, I wish I had one of those crystal balls, or how high do you think it'll go? You know, I mean, you know, you just can't predict that whatsoever. Yes, did you have a quick question?
Yeah. When you say earnings per share, what are you basing your earnings on? Is it realised, is it the
Realised profits.
Realised profits?
Yeah, it's the earnings per share after tax profits.
So none of this significant items?
No,
just the
no. It's after everything. Yeah. So there's no fudging in those numbers. They're the actual real earnings per share. Blackmores, I had to put this one up because, yeah, yes.
Isn't this typical of New York shares over this period?
Over which?
It's gone down.
Which shares?
All of them.
All of them. Well,
During this period, all shares, or nearly all,
yeah.
have been going down just like that.
Well, yeah, if you look at the ASX 200, A lot of them have been, with the exception of the one I'm just about to show you. But you know, not the healthcare sector's been doing still like CSL.
No, but it's not
It's,
that these companies have been going down.
yes.
It's that the whole market has been dragging.
Yeah, but like I said, again, you want to focus on the sectors that are still moving up, the strong sectors. You know, I did say, and I'll talk about the banks in a moment, but you know, everybody was falling over themselves to buy the banks in March, April, and I said on TV at the time, you know, this is a yield trap. You know, it's just, you know, I could see it. It's just, this is what people are doing. They panic because interest rates are going down, and that was the first rate cut by the RBA in February. But it comes back to what are you willing to pay, you know, and things get a little bit out of skew, and that's where there's opportunities. Yes.
Do you run technical analysis, i.e. trends,
Yeah.
on the XJO,
Yeah.
XAO and individual sectors before you go into those sectors?
Absolutely. Well.
In addition to other
Oh yeah,
analysis?
yeah. I've been studying technical analysis now for well over 25 years, and my rules apply to anything. As stocks, commodities, currencies, indices, it doesn't matter what it is. They all trend. It applies across the board. And to me, it's one of the most important things to learn because timing is everything, as far as I'm concerned. Timing is everything. Fundamentals, critical, but timing is everything. And that's what I've learned the hard way. Like I was saying, I could be looking at a company and go, but the fundamentals are strong, and yet the stock price continues to go down. Because the last thing people hate is losing money. And I've learned sentiment rules the day. And it certainly shows, like this next stock here, look at the sentiment here, Blackmore's. I mean, look at this, you know, company from a market cap last year and the year before, 450 million, suddenly jumped to 1.3 billion when they reported this year. Now they're 2.2 billion today from June, July. You know, now, you know, the earnings for the prior 2 years, you know, nothing to get excited, but suddenly there's an 80% jump in earnings and everybody's excited, and, you know, return on equity has jumped, which is great, and that jumps to a 28 times PE. Now, it may deserve that, but then you've got it's only 1 year. And now that earnings multiple is over 50. Over 50. Now, when you consider their profit was $46 million net on a market cap value of 2.2 billion, geez, you have some very high expectations there. You know, the yield has come right down. It's now half of that. It's about 1.5, 1.4%. You know, but you know, this is what's happening to the share price as we speak. So if you've got any Blackmores, I would certainly be. This is, you know, I've seen so many charts like this in the past. You don't know how high this frenzy can go, but let me tell you, after it ends, it's going to come down very quickly as well. And I've seen that over many years. So anyway, enjoy the ride. But if you've got any Blackmores, like I said, I'd be selling, but I certainly wouldn't be rushing in to buy today. That's for sure. So very expensive. But obviously, you know, there's a craze at the moment for you know, these nutritional products or you know, vitamins. Now, I thought I'd bring up, you know, just a change of scenery, the miners, you know, and I thought I'd bring up Newcrest, just an example of what to look out for when you look at mining stocks and how to avoid, you know, bad ones. So this was, I couldn't believe this when people were buying Newcrest at $40, $42, and I saw the trend of gold starting to head down after 2011. And this was in June 2012. You can see their earnings dropped 4%, still trading on a price to earnings ratio of 16, low PE of 10. So to me, you wouldn't have been rushing in to buy Newcrest at that time. And then of course, look what happened. The gold price continued to fall. Their earnings fell 56%. Their return on equity 6%, still on a PE of 16, can you believe? Had people buying the share, and the dividend dropped to 12 cents, 1% dividend yield, no dividend for 2014. Share price sort of steadied a bit, but still the earnings was down. Plus they had that disaster with Lahire. still on a high earnings multiple, still around 16, I believe, 15, 16 today. But look at the trend. Now, you know, this to me, you know, up here is where there was the exit. When it broke below this low here and it started trending down, this was up here around $36, $37. And I remember a fund manager coming down from P&G. They managed, it was a reasonable fund, $100 million, and they lost 20% of it in that year because their biggest holding was Newcrest. And they came to my program to learn how to read charts. So the exit for Newcrest was $35, $36. That was like, regardless. That's when the trend, by my rules, started moving down and continued to move down with the gold price. Actually, at this level down here today, I actually don't mind Newcrest because I'm actually quite bullish on gold, and I think gold could start to move back up for many reasons. And in fact, it's a sector that's overlooked right now, the gold sector. If you look at the Aussie dollar gold price and the margins they're making, not the big cap sector, I'm not talking, you know, Newcrest is not a standout for me, but other companies like Evolution, of course, Northern Star, but even smaller ones, I'm seeing bargains. And they're the ones that I look for, actually, in the space. They have the greatest upside potential, is the smaller mid-cap area that are generating very positive cash flow. And I'm looking at numbers I've never seen in 30 years, so I'm quite excited at the moment on some of the stocks that are out there. But I'm starting to become a lot more positive on the gold sector. But we'll wait, still waiting for evidence that the gold prices, it moved up a little bit last night, but there's lots of good reasons, I think fundamental reasons for gold to move much higher. But still, even at this price level, these companies are making a lot of money. And here's the gold price right now. Now, it did move up last night, but look, if you get a break above 1,300 on the gold price, US, this is the US dollar price, right now in Aussie terms, it's around 1,600 Aussie, and most of these miners are producing at around, you know, the bigger ones are around 1,000, 1,100, so they're making about $500 an ounce. So if you measure that, if they're producing 100,000 ounces, that's 50 million profit. It's quite good for a 100,000 ounce producer. But right now the trend is not positive on gold, but I'm watching it very carefully because I think if there's a break, like I said, a move up to 1,300, which I'm expecting, and a break above that, we could see gold come back to in favour again. Here's another one, Fortescue. I've talked about this company many times in the past. This has been a big loser for shareholders, and because I was warning that if the iron ore price fell below 100 US a tonne, I would avoid Fortescue completely. I actually like it now for good reasons, and I thought I'd tell you why. Now this is the numbers of their last report. Now that 10-cent earnings per share, what you've got to take into account is they had impairment charges of 1.4 billion, so their net profit was about 490 million after impairment and tax. But their, like I said, the impairment charge, which is a non-cash item, was 1.4 billion. So they made 2 billion profit for this year on a lower iron ore price, and that's on a price to earnings multiple of 3, not 19 like you see there. So you've got to look underneath the numbers. So it says 19, but like I said, when you add back the impairment, they're actually at 3 times. And the dividend yield, it's not fantastic, it's 2.5%. But the reason I like it is, again, because of the Aussie dollar and because the iron ore price has moved up to around 58, 59 US. This is, I predict going forward, if that maintains that level, if the iron ore price stays above 50 US and the Aussie dollar stays where it is around 70, 71, then the full-year profit for Fortescue will be quite something analysts will be surprised, in my view. I would be surprised if they come out with a 2.5, 3 billion net profit, which would be very attractive and increased dividend, but also any asset sales as well. So I'm a contrarian investor is what I'm telling you. I look for opportunities at bargain basement prices. And so when I look at the share price, which is where it is down here today, it's moved above $2 recently. That share price has come down to the lows back in 2008-09. I mean, can you believe once upon a time the share price was over $13? This is before they even moved one bit of dirt, and it was made no earnings. I mean, this was just, again, you know, the flavour of the month. Like, you could see that spike up and how quickly it came back. Now, at this level, they are definitely generating some very strong cash flow. So I quite favour this sector right now. Of course, with the caveat that China doesn't sort of have a hard landing. But again, keep a close eye on the iron ore price. But as long as it stays where it is, I'm very positive, and I think this one could outperform the market over the next 12 months, is my view. So it's one of the ones I thought I'd throw out there and show you today. Now, this is the iron ore price. You can see it trended down since those highs in 2011, all the way down to that recent low, and it's formed what I call a technical double bottom pattern there. You can see those two bottoms. So if it continues to bounce, and particularly above 63, that'll be a very positive trend. But certainly, it's hurt a lot of miners out there, especially the likes of BCI and Atlas and those ones. But again, when you look at Rio, BHP and Fortescue, they're the three lowest cost iron ore producers in the world. And the other thing most people don't realise is that outside of Australia, that China produces 40% iron ore and they cannot make money below $120 a tonne. So that'll be a supply that comes out of the market and has to be replenished. So again, the jury's out in terms of what happens to China, because there's so many conflicting reports about it. I mean, longer term, you've got to be bullish on China, but in the interim period, you've got to be cautious, I think. Okay, now finally, talking about money management, risk management. It's a bit like this for most investors. It's like walking a tightrope. And Commonwealth Bank is a good example I just thought I'd use. I mean, you could see what a stunning performance this has been. And this is 40% of the market is represented by banks. That's the problem with our stock market, is the top 20 companies represent 60% of our market, and banks represent 40%. So we're very heavily weighted in the banking sector on the ASX 200. And everybody who invests in superannuation funds, whether directly or indirectly, is invested in the share market and the ASX 200. My concern is, I think our market is so top heavy in the banks, and I said this at the highs in March, April. I mean, it's been an unbelievable growth, but there's also been an extraordinary growth in debt. And that's one of the biggest concerns, as Glenn Stevens has been saying, is, you know, that we've got $1 trillion in mortgage loans, and half of that is interest only. And, you know, we've got this asset bubble happening at the moment, particularly in Sydney. So I'm a bit cautious about the banks. I mean, there's still, what alternative is there right now? But I'm warning investors, and I warned them up the top here. I said, don't get, conned into buying the stock up, these bank shares up here, and that's what people are doing, taking their money out of the bank and buying the bank shares at the high. And at that point, CBA was the 8th largest retail bank in the world. When you think about a population of 25 million, that's like putting all the banks together in Germany and saying Commonwealth Bank is worth more than all the banks in Germany, just to put you in perspective. Our 4 banks in the top 20 in the world. So, you know, anybody who doesn't think we're leveraged to debt, I think, you know, you need to really have a look at the numbers. So that's the biggest concern going forward for our economy. Obviously, if there's a massive slowdown, and particularly in China, you have to be cautious with the banks, is what I'm saying going forward. I'm not saying sell them right now. I'm saying if you bought them years ago, you'd still be holding. But geez, you've got to watch the trend going forward. And this is what happened, like I was saying, people were chasing the cheese, the yield. But it turned out to be a trap. So what I tell people is, to avoid the trap, you've got to have what I call, in a moment, a different strategy. But you can see what happened here is that the share price went, in fact, touched up near 97, and just since March fell to a low of $71. It's a loss of 26%. It's a lot of dividends over years. Now, it's come down to a very key support level here, but the trend is still weak. And I'm not optimistic about the growth of banks going forward for the reasons that I've told you, but I wouldn't be selling right now if you're a shareholder. Unfortunately, those who bought at the high, when everybody was ramping it. The other reason is, of course, the Aussie dollar falling. A lot of overseas investors had to jump out of the banks as well. But, you know, just in the space of, you can see on the chart there, 9 months, look at the volatility just in Commonwealth Bank alone and the other banks. So right now, I mean, the yield for ANZ, Westpac and NAB are very attractive coming up to their reporting period. So this is what I mean about protecting yourself. A lot of self-managed super funds out there don't know how to manage their risk. Instead of having a stop loss, I call it having a guaranteed loss, stop loss, which is using derivatives or options, is one way to do that. And I certainly was recommending that to clients, to sell, if you understand options, selling call options to pay for your insurance at the highs. So that's a very good strategy in terms of how to protect your downside risk, because you never know when you wake up in the morning, as I did, and I know some of you did in October 1987, even if you had a stop loss, it didn't help you very much the next day when you get a gap down. So I like using derivatives or options as a protection or hedging strategy, like buying insurance to protect the value so you can sleep at night. And I don't go for 12 months insurance, I do it every 3 months. So you can roll out that insurance and it's not expensive to do. So it's a very good strategy, and that's where, you know, you could have bought protection very cheaply at $90 on a Commonwealth Bank when it was up at 95. It would have cost you nothing. So again, protect your stock portfolio. So if the market falls, you don't look like this. And I thought this was an ad I liked in the US, hiding from a big bad bear market is not an option. And we've been in a fantastic, economic environment for 24 years. We haven't had a recession. You know, you've got to wonder, and I was in banking for 12 years. Like I said, I was a CFO, and I've never seen banks have such a dream run, like the lowest provision for bad and doubtful debts that I've ever seen. You know, but sooner or later, you've got to wonder, you know, how many times can it come up red, or black, I should say, before it comes up red. So that's the big thing going forward. Indicators like unemployment and what's happening globally. I love this quote by Warren Buffett. If the markets were rational, I'd be sitting in a gutter with a tin cup in my hand. And that's the truth. They're the opportunities that I see all the time, is when the investors are being irrational. They're paying too much, or they're selling at ridiculously rock bottom prices. And I gave one example of that was Fortescue, which, like I said, at the moment, to me is compelling value as long as the iron ore price remains stable. And George Soros, two of the best money managers in the world. George Soros, who runs the Quantum Fund. In fact, George Soros and Warren Buffett were born in the same year during the Great Depression, 1929, I think it was. And I love this quote, and I think this says it all. It's not whether you're right or wrong that matters, but how much money you make when you're right and how much you don't lose when you're wrong. And this is the problem for most investors. They hate being wrong, admitting to being wrong, and they'll even justify being right by saying, well, I'm a long-term investor anyway, and that's what they do, is they hold on for dear life, rather than admitting you're wrong or having a strategy to get out that supersedes your emotions, basically. So again, I went through those common investor issues. What we offer is giving investors confidence, how to apply strategies, learning a simple methodology for identifying growing businesses with excellent results, and not requiring a lot of time. You know, you don't have to sit in front of the computer all day. You know, learning entry is very important, knowing when to get in and when to get out. And the money management rules are critical and will keep you safe. And basically, like I said, whatever strategy you use, it's, you know, not based on your instinct or intuition, it's based on fact and what's happening in reality when you look at the chart, and it tells you when to sell, not when you think you should. Again, this is the curriculum of our 3 courses. We are having a course coming up soon in Sydney. Invest for Success is our 2-day workshop. If you are interested, it's on Saturday and Sunday, the 24th to 25th of October, over the weekend from 9:45 to 6:30 p.m. And we're offering a $200 discount to anybody from the Australian Shareholders Association. Kate, we have I think feedback sheets if you wanted to, at the front table, they're the yellow ones. If if you want to fill out a feedback form, we can get in contact with you. And I love, finally, this quote, if you think education is expensive, try ignorance. Now, a final psychological test before I wrap up. Pick a symbol, any symbol, don't think too hard about it. This is tell you what kind of investor you are. Has everybody got a symbol? Yeah? Okay, who picked the square or rectangle? Okay, it's a small handful. Conservative investors, mainly interested in dividends, likely to invest in quality blue chip shares. Triangles. Okay, triangles. Moderate risk takers, want capital gain rather than dividends, likely to invest in growing companies. What about the Zs? I've got a few Zs. Visionaries, open to new concepts, will take high risks in the hope for high returns, likely to invest in speculative stocks. What about circles? Okay. These are party people. They don't care where they invest their money as long as they have enough for a good time. Thank you very much, and that's the end. That concludes my presentation.
We have a few minutes left for some questions for David. So, are there any questions? I'll start up, David. You mentioned the miners. Do you have a view on monadelphous?
Yes. Yeah, I actually, someone asked me that on TV when I was on Your Money, Your Call, I think a week or so ago. I like monadelphous. I think monadelphous, the yield that I looked at, I think is about 11% forward yield, which seems incredibly, that's even after discounting the dividend, fully franked. I like the financials of it. I like where it's trading at the moment. It's come down to a very low price point. So definitely monadelphous, I think in the mining services space is looking very attractive. Yep.
Gentleman there.
Thank you for a very interesting presentation, David.
Thank you, my pleasure.
Question I'd like to ask is you obviously look at macro.
Absolutely.
And can you perhaps give us your thoughts on what will happen if and when the Fed in America puts up its interest rates?
Sure, good question.
And how will it affect us?
Yeah, absolutely.
Can we get the microphone?
Yeah, that's the hot topic right now. Here's the joke for me, okay? I think it's a joke, is that, you're talking about a 0.25% rate rise. I mean, they're probably, I wouldn't be surprised if Janet Yellen comes out tonight and says 0.1 of, just to keep the market happy, or 0.15, But we're not talking about a significant rate rise here, but everybody's blowing this whole thing out. What concerns me the most, and it's not just me, I mean, I listen to the smartest people on the planet like Carl Icahn, Stanley Druckenmiller, who's he's the best fund manager in the world over the last 35 years, right-hand man to George Soros. So listen to George Soros. What you have to appreciate, and this is what they're saying as well, is that the debt situation has not gone down, it's escalated since the GFC. If you look at global growth, global debt particularly for governments, if you look at the US government debt right now, 18 trillion, they're going to hit again, there's going to be a big debate about the debt ceiling limit later this year. But here's the big problem that I see. And this is not just from, I'm not just saying this is the smartest money people on the planet saying this, that the bond market, and particularly when you look at corporate bonds, high yielding bonds and government bonds, is not pricing in for risk. There's a mispricing because of the QE program that's been going for the last 6 years. And that's caused this massive imbalance. And what you're seeing is there's likely going to be another crisis somewhere. I can name you a number of, if you take the shale oil producers in the US, they're not making money below 55, 60 US a barrel. They've got $1 trillion in debt. Look at car loans in the US, they're nearly $1 trillion. Interest only, not even interest only, interest-free loans like 6 years, this is another subprime. Look at college loans. So, the debt scenario situation it's just been skewed or mispriced by the Fed, action by the US Federal Reserve. Now, I'm not saying they shouldn't have taken action. Obviously, they had to take action, otherwise we would have been in a global depression. But they've gone too far with it, and they're leaving their run too late to raise interest rates. So it shows you the lack of confidence they have. So to me, it's insignificant about what happens tonight, whether they raise or not raise. It's what's lurking behind, and particularly in the junk bond and corporate bond high yield market, which the spread is widening between government bonds and junk bond, and that's what happened prior to the GFC. And if something comes out of left field, you'll see a spike in interest rates, and it won't be, with the Fed can't do anything about that. It'll be the bond market that falls very sharply and interest rates go up, regardless of what the central bank does. So that's my biggest concern and a big caution, and why I'm saying that could happen at any time.
This lady there.
You haven't really mentioned anything about oil. Could you give some comments about oil, and in particular the one that everyone's talking about in Australia, Santos?
Okay, if you want to, I was on Lunch Money on Monday. I'm regularly every fortnight. If you go to our website and go to my blog, you'll see the interview I gave about oil. As I actually talked about, I'm bullish. I said Goldman Sachs was giving a very bearish forecast, and they asked me my opinion. And you can go and see the blog if you go, and you'll see the clips from just on Monday. And you saw oil rally 6% last night, funny enough. The reason I like it is because, you're always going to need energy oil. And the other thing is the supply is starting to come out of the market because, like I was saying, shale oil producers, drillers have cut back on exploration. It's very expensive to find oil. So I'm not overly bearish, but, technically speaking, it needs to break above, firstly, $50 and then get back to 60. Once it breaks above 60, what you've got to understand about commodities, particularly crude, is it's not driven by fundamentals. This is what people think. It's driven by traders. Traders drive the oil market. If the oil price is going up, the short sellers will cover their shorts, and then you'll get the longs going. I promise you, if oil breaks above $60, just watch it go. All the traders in the world will be buying it. And that's what moves the oil market, more than all this supply and demand. Look at the GFC, when it went up to, 110, then it collapsed to 30, if you remember, in one year, and then went back to 110. When it was trading at 110, everybody was saying, oh, we've got a supply shortage. I'm going, that's ridiculous. No, it's traders. They're pushing it. It's got nothing to do with that. So there's all this noise but just watch the chart. And so you can't be overly bullish on crude right now, but I'm saying if this move to last night, up 6%, keeps going and breaks certain levels, then you'll see a bigger rise coming. And when you look at Woodside, you've got to look at Woodside and see, the value there. Santos is obviously, underperformed, but it's certainly got some good assets. And then you look at Oil Search, so in the energy sector, especially in the mid-cap, there's incredible value down there. And I'm surprised and shocked there's not more M&A activity. That's what I said. I'm really shocked that there's not more mergers going on at the moment. Yes.
Okay. This will be the last question.
Okay. Could you say something more about bonds, please? Because it comes up so often.
Yeah.
A little more.
Okay, just briefly, it's an IOU. The government gives you an IOU. You lend them the money for 10 years, 20 years or 30 years, like in the US. And, they give you a fixed interest every year. Like right now, if you bought a treasury bond or lent the money to the US government, they're going to pay you a whopping, 2.2% interest every year for the next 10 years. Then you give back that piece of paper, the bond, and they'll give you back your capital. So you're guaranteed to get back your capital. But bonds are very liquid. They're one of the most liquid markets, so it's very easy to sell that paper in the market like shares. So if interest rates go down, the capital value of the bond goes up. Now what's been happening is the last 30 years, the value of bonds have been going up. It's been what they call the longest secular bull market in history in bonds because of interest rates going down. That's a bubble right now. So now Warren Buffett said this as well. Anybody buying bonds up here needs their head read for 2%, like really, seriously. And that's the concern that nobody's talking about is the bond market. And I've raised this when I was on the show called Bonds versus Equities, and I wasn't invited back again. Anyway.
Right. David, you've shown us some fascinating statistics. You've been prepared to talk about specific companies and trends and fundamentals, which are what we love to hear about here. So thank you very much for your presentation.
Thank you.